Good day, all. We are here to talk about types of credit facilities given out by the banks. Types of credit facilities given out by banks. You know, if you approach a bank, they have a lot of credit facilities for a particular group of customers, and each customer have the kind of facility that is peculiar to him. No two customers are the same. So banks usually bring out these products or services to fit into various categories of customers. So we're here to look at the types of credit facilities the banks give out to customers. The question now is, what is credit? There is notion about credit which some people they say, what is actually credit when they hear the term credit? But credit is all about those loans or what they call those advances which banks give you by way of loan so that you can do business with them and return it to customer. It's called credit. What you give out, what somebody owes you, is credit. Once banks give out their money to you, you are owing them. So it's credit. So all those advances, or collectively called loan, which banks normally give out, they are credit. Whether it's masquerading one form of other, bill of exchange, letters of credit, term loan, short-term loan, or whatever name is going, they are all called credit. Whether it is IFF, import finance facility, and other kinds of loan, they are all forms of credit. So we now know what credit is. My question is, what are the types of credit facilities that are available in the banking system? And of course, to the customer. We have overdraft. We have revolving overdraft. We have a simple overdraft. We have one-off overdraft. So if you have need to take overdraft from a customer, the money you call overdraft is what you take beyond what you have. Suppose you have $1 million, you are in need like $2.5 million, you can approach your bank to grant you that overdraft under some specified conditions. That's overdraft. And then you now choose by their business structure, that's going to be revolving overdraft, or it's going to be just one simple term of overdraft. So overdraft normally helps to beef off working capital. Assuming you are doing business and you don't have enough cash to finance a particular business and you know it's going to generate enough profit, banks can give you overdraft once you are creditworthy. Once they have done their credit checks and check their risk assessment criteria and you fall within their target market, they will give you overdraft. Then we have another type called temporary overdraft. Normally, temporary overdraft lasts minimum of 30 days or maximum of, up to 30 days or maximum of even 40. But it's a temporary kind of overdraft. It's more temporary than the real overdraft. Overdraft could take some months or even up to 1 year, depending on the structure. But temporary overdraft is designed to take a shorter tenor. Most cases is 30 days or maximum of 40. They give you temporary overdraft. We have other ones, term loan, or what is also called time loan. Some people call it time loan. But whether time loan or time loan, the loan is all about giving you money for a specific period of time under some specified conditions. You're going to determine the bank charges, you're going to agree the bank charges with the bank, the interest charges, and the rest of them. But normally the term loan or the time loan is time-based. It's tied to time, specific period, and in most cases it's a one-off. Though you can renew it if you wish, but it is designed such a way that to run off, and then both the principal and interest will be returned, and then you can ask for a fresh one if you so desire. So term loan and time loans are one of the credit facilities given out by banks, and they are designed specifically to help customers in their business and other areas where they need it. We have import finance facility, what we call IFF. Normally it comes by way of either bill of exchange or letters of credit. But those import finance facilities, or whatever name it is called, they are designed to help you to import goods in a particular group, in a particular country or in a particular area. Normally, it helps in international business. Most of the documentation is acceptable in international business. There are international business documentations that requires, but it's designed in such a way that it will help you to import goods into a particular country. So each bank have their peculiar way they designed it, the IFF, but by and large, it's all about importing. It's all about importation of goods. So that's why I call it import finance facility. So, like I said, that's why you have letters of credit being used, and even bill of exchange, and any other kind of even overdraft or whatever terminology they wish to use. But it's IFF designed for importers. Normally, one of the advantages of IFF is that it takes a longer tenure than overdraft, because they know you're going to import it, you're going to clear the goods, you're going to do all the custom requirements. It's going to take some time to import from one country to the other. So the tenure is usually longer, so it's longer than the normal temporary overdraft and overdraft. So that's one advantage. And then, of course, the charges are a little bit less than the other ones, because they know that it will take some time. In most cases, they are even moratorium depending on the agreement with the bank. They will probably manufacture the goods over there, take some time, they will ship it before it arrives, before you do the clearing process and all that. So it normally takes longer time, 30 days, 60 days, 1 year. It's a longer tenure. They allow it to run in circles, depending on the bank. But however, the tenure is issue that you resolve with the bank. So my IFF are designed to even run shorter terms, like even 30 days, depending on how it is structured or how you want it. But the idea is you discuss with your bank, they will tell you what's acceptable to them and what is not. They talk about local purchase order, what people call LPO. Sometimes you're a supplier of goods or services to a company, and they give you order to supply within a specified time, and you don't have enough money to do it. The usage of local purchase order normally comes with time. It's time-based. So if you don't have money, you can approach your bank. Show them evidence that you have the LPO. They will investigate and find out that it's from a reputable company. Bank can deal. They can finance the LPO for you. And of course, you're going to share the profits with the bank, and then you take your own profit. Normally, when they are financing the LPO, they look at the contract details and see whether the financing would ensure that you have enough flow, both the principal and interest they're going to charge you be covered, and also even have enough by way of profit so that your business can equally grow. So these are the considerations you do during local purchase order financing, what we call LPO. Then we have contract financing. So many people collect contracts from either government bodies or from private companies, or various agencies, or various groups. But sometimes you won't have enough money to finance it. The banks can do the contract financing, look at the details of the contract, look at the contract terms, and then see if it's a contract they would like to risk their money with. And once it's acceptable to the bank, they will deal. So normally they can even give something like APG, Advanced Payment Guarantee, another kind of bank guarantee that would enable the contract financing to be successful. So these are products, credit facilities which banks have designed to help you to grow in your business. So find out from them how they do contract financing, and they will help you to finance your contract. Then we have invoice discounting. Many times people have pro forma invoice, another kind of invoice, and sometimes you don't have enough money to finance it. The onus is on you to also meet your bank. You look at the details of the invoice, see how they can discount it so that they will finance the invoice, so that you meet all the terms given to you by the person who gave you the invoice, and then they will also take back their money together with the interest, both the principal and interest. But bank will look at the details of the invoice so that they will know that the volume of money coming into the business through that invoice will cover both the principal and the interest which are going to charge. So, but it's one of the credit facilities that are available to customers, invoice discounting. Then invoice financing. So people call it discounting. Why you call it discounting? It's like sometimes you don't take the full value anymore because bank will now come in and take part of the profit. So some people call it invoice finance or invoice discounting, but whatever terminology it goes with, not so much. It's not all that important. All important is how will the bank finance it for you, so that you can grow your business with it. Then we have check discounting. Many a time you have to meet working capital, you have to meet some needs at a very short time. Instead of waiting for the full considerations to be made, you can go for check discounting, especially if the money is not so much. You can meet the bank, they will look at what you want to finance. Then they could write a check payable to the bank. Then the bank will supply the money, but they will make sure that the volume of money they will give you will cover the business you want to finance, including their interest in the business by way of interest and other bank charges, which are going to give you during the process of financing the check. So check discounting is one of another way bank gives money to the bank. Some people can call it check financing, but in most cases it's called check discounting. But whatever terminology it goes is not all that important. Each bank have their terminology to use. But the principal one is that check discounting is possible. Then we have warehousing facility, or what they call stock finance. Many times, especially those into importation business and export business, you must have to keep a warehouse to enable your goods to go. And especially the volume of goods you are going to import or export will be large. So you may require you to have a warehouse. And you may not have enough money to do all the warehousing details. So you approach your bank, they can finance the warehouse, what we call warehousing financing. Look at the stock. Though in many cases, in that case, it may not even require extra collateral. The collateral may even be the stock, the warehouse. And in some cases, it may be a tripartite arrangement that bank will even monitor the movement of goods through that warehouse. They can even post the security personnel in that place to finance that warehousing facility. But by and large, it's a credit facility that is available to customers. So check the kind of business you want to do. Check whether it fits into the structure, the various types of credit structure, and see how you can take advantage of it. So we have discussed what is credit. We have seen the types of credit facilities available. The ball is now in your court as a customer. Check how each of the credits will be of benefit to you. Then approach your bank and discuss with them. And I want to believe that they would give you a positive reply. So in a nutshell, I wish to encourage you to subscribe to my channel at YouTube, because I'll be giving you other credit facilities, because this is not exhaustive. I'll be bringing out other facilities as banks bring them out, so that will educate your mind and you'll be able to know how you can take advantage of these facilities. Use it to advance the course of your business. Thank you for your time. Thank you for listening to me. Thank you for also anticipated subscription to my YouTube channel, and I hope to see you again.